All right, so are you ready to kind of get a grip on like what day trading's all about?
Yeah.
And maybe at the same time figure out how to actually understand those, company financials.
Sounds intense.
It is. But that's why we're doing a deep dive today, right?
Right into the thick of it.
Exactly. We've got this article from Blueberry Markets all about day trading strategies. And then from Harvard Business School Online, we've got this whole guide on reading financial statements.
Which can be a bit of a mystery sometimes, right?
Oh, absolutely. But by the end of this, you'll have a much better idea of what to actually look for.
When you're checking out a company.
Yeah. Or even if you're thinking like, hey, maybe I should try this day trading thing.
It's a wild world, that's for sure. You've got like the high energy, fast paced day trading where things happen so quickly. And then you've got this more like, careful analysis of a company's financials.
Like two different speeds almost.
Totally, totally. With day trading, you're looking at profits and losses that happen in the blink of an eye.
And Blueberry Markets, they really emphasize how intense it can be.
Oh, yeah.
They talk about analyzing charts where prices change like minute by minute.
Sometimes even faster. It's not for the faint of heart.
So it's not just like picking stocks and hoping for the best, right?
No, definitely not. Day traders, they're looking for tiny, tiny fluctuations in price.
That most of us wouldn't even notice, probably.
Exactly, like little micro movements. They're trying to like exploit those. And that takes, a certain mindset and definitely a tolerance for risk.
Okay, so let's get into some of these strategies. Blueberry Markets mentions scalping, which sounds kind of funny.
Yeah, like what is that?
Right. But it's basically making a ton of trades all day long, each one for a tiny profit. It's almost like imagine trying to grab a penny off a moving carousel, like that kind of quick in and out.
Cool about like volume and timing. Getting that right, though, that takes practice. It's not as easy as it might sound.
So not for the person who checks their stocks like once a month.
Yeah, no, scalping's really for traders who are like glued to their screens, constantly watching charts, looking for those split-second opportunities.
Sounds exhausting.
It can be, for sure. And you need a high-risk tolerance and a platform that can, execute those trades super fast because every millisecond counts.
Now, Blueberry Markets also talks about news trading, which at first sounds a bit more, I don't know, grounded maybe.
You'd think, right? Just follow the news and boom, profits.
Yeah.
If only we're that simple. News trading, it's not just reading headlines.
Got to be more than that.
It really is. It's about like figuring out how the market's going to react to the news.
Before it even happens.
Sometimes, yeah, like you have to kind of anticipate how other traders are gonna interpret the information, whether it's, an earnings report or some big economic announcement or even like a geopolitical event.
So you're not just reading the news, you're reading the minds of other traders.
In a way, yeah, you need a deep understanding of like how the market works, but also the psychology of the people in it.
Okay, that's a whole other level of market savvy. Now, then there's this thing called fade trading. Blueberry Markets makes it sound like you're basically going against the trend.
Yeah, like everyone's buying, you're selling, everyone's selling, you're buying.
Talk about swimming upstream.
Totally. But fade traders, they're looking for when a stock or even the whole market seems to be getting overbought or oversold.
How they even spot that?
Well, there are technical indicators they use, like, comparing the price to its moving average or looking at the volume of trades, but they're also trying to like sense the mood.
The mood.
Yeah, like, is there euphoria? Is there panic? Those extreme emotions can be a sign that things are about to change direction.
So it's a mix of like technical analysis and gut feeling.
Absolutely. Honed by experience and, that deep understanding of market psychology.
So it sounds like these day trading strategies, they're all about like speed, timing, and being able to read those subtle cues from the market.
It's like being a master chess player, maybe. Always thinking a few steps ahead.
But what about understanding the companies themselves, like the stuff behind the ticker symbols, the fundamentals, right?
That's where this Harvard Business School guide comes in. They really stress how important it is to understand financial statements. Not just for investors, but for anyone in business, really.
Anyone.
Yeah. Entrepreneurs, managers, even if you're just trying to like manage your own finances better, it's about learning to read the language of business.
Which can be pretty intimidating sometimes, right?
Oh,
All those numbers and jargon.
definitely. But once you know what to look for, it's like, you've got this secret decoder ring.
I like that analogy.
Right. You can unlock the mysteries of those financial statements.
So it's like putting on our detective hats and looking under the hood of a company.
Exactly. And one of the first clues we got to examine is the balance sheet.
Okay, the balance sheet. Now, remind me, what is that again? It's like
Think of it as a snapshot, like a photograph of the company's financial position.
at a specific moment in time, right?
Right. It tells you what the company owns, those are its assets, what it owes, those are liabilities, and then how much the shareholders have invested, which is equity.
Ah, yes, the famous equation. Assets equal liabilities plus equity. But what can we actually learn from this balance sheet? Like, what should we be looking for beyond just the numbers themselves?
Well, one important thing is to look at the quality of those assets. Are they things you can actually touch, like, buildings and equipment? Or are they more like ideas and reputation, which are harder to measure?
Tangible versus intangible.
Yeah, exactly. And then how easy is it to turn those assets into cash if they needed to? And how much debt does the company have compared to its equity? These are all clues that can help you understand how strong and stable the company really is.
So it's not just about how much company's worth on paper, but like what makes up that worth.
Right. A company with a ton of debt might look okay at first glance, but if their assets are like tied up and losing value,
Yeah.
that could be a sign of trouble.
Oh, that makes sense.
It's like, you know how your car loses value every year?
Tell me about it.
Well, companies have that happen too, especially with things like machinery and equipment.
So it's kind of like wear and tear.
Yeah, it's called depreciation. And a savvy investor, they can spot if a company's depreciation is like way off compared to others in the same industry.
Or if they're trying to hide something.
Exactly, like trying to make their future costs look lower than they really are.
So even a detail like depreciation can tell us a lot about a company.
Absolutely. It's like a little clue that can reveal a bigger story. And that's just one piece of the puzzle. The balance sheet, it's really just the starting point.
Okay, so we've taken our snapshot with the balance sheet. What's the next step in our financial detective work?
Next, we move on to the income statement. This one tells the story of the company's performance over a period of time.
So not just a single moment, but like a whole chapter.
Exactly. Usually it covers a quarter or a whole year, and it shows how much revenue the company made.
So like their total sales.
Right. And then how much it cost them to make those sales. That's called CARGS, or cost of goods sold.
Okay, Kodiesi. Got it.
And then what's left over, that's their profit.
So it's not just about how much money they bring in, but how much they actually get to keep.
Precisely. Two companies could have the exact same revenue, but the one with lower costs, they'll have higher profit margins.
Which means they're running things more efficiently.
Exactly. And that usually means they're in a stronger position overall. The income statement, it helps us see how good a company is at making money consistently over time.
I'm seeing how these financial statements can be really powerful tools for investors, especially when you're comparing companies in the same industry.
Absolutely. You're peeking behind the curtain of their operations. It can help you make smarter decisions about where to put your money, especially if you're thinking long term.
Okay, we've got the balance sheet, the income statement. What other financial mysteries are we going to uncover today?
Well, hold on tight because now we're getting to the cash flow statement. And that's where things get really interesting.
All right, bring on the cash flow. I'm ready to keep digging. Okay, so we've been like really digging into these financial statements.
Yeah, it's amazing how much information they pack in, isn't it?
It's like each one's a different piece of the puzzle.
Each one tells a different part of the story.
Exactly. So we've got the balance sheet giving us that snapshot in time, then the income statement showing us profitability. But now we're onto this cash flow statement. At Harvard Business School, they really emphasize this one. Why is that? What's so special about cash flow?
Well, it's because the cash flow statement, it tracks the actual movement of money, right?
And flow of cash, yeah.
And that can tell a totally different story than just looking at profit. Like, you can have a company that looks profitable on paper.
But they're actually struggling.
Exactly. Because if they're not managing their cash well, they can run into trouble, even if they're making a profit.
I've always heard that saying, cash is king. But I never really understood how that applied to, like, a big company. It's not like they're stashing bills under a mattress, right?
Right. Haha. It's not about physical cash, but the idea is kind of similar. Think of it this way. What if a company makes a huge sale, but the customer takes, like, 6 months to pay?
Oh, I see. So on their books, it looks like they've got all this revenue.
But if they have bills coming due right now, that profit doesn't really help, does it?
And not if they can't actually access the money.
Exactly.
Mm-hmm.
That's what the cash flow statement helps us see. Does this company have enough cash on hand to, keep the lights on, pay their employees, invest in new stuff, and pay off their debts?
Okay, so it's about timing, making sure they've got enough fuel in the tank to keep running. But how do we actually read this statement? Like, what are the key sections we should be looking at?
All right, so the cash flow statement, it's broken down into three main activities: operating, investing, and financing. Start with operating activities. This is the cash flow that comes from their main business, like the day-to-day of making and selling their product or service.
So that's where you want to see consistent positive cash flow, right?
Absolutely.
Uh,
That means their core business is actually generating cash.
Makes sense. That's their bread and butter.
Mm.
But what about growth? Companies can't just, like, stay the same forever, right? They got to expand, innovate, all that.
You're right. And that's where investing activities come in. This section tracks the cash they spend on those long-term assets. Things like buying new equipment, upgrading their technology, or even acquiring other companies.
So would that usually show negative cash flow? Because there's spending money now to hopefully make more money later.
Exactly. It's an investment in the future. So you're right. It often shows up as negative cash flow.
So let me see if I've got this straight. A healthy company, ideally, they should have strong positive cash flow from their operations, showing their main business is doing well.
Right.
And then they'll probably have some negative cash flow from investing, which shows they're actually thinking about the future.
You got it. That's the sign of a company that's not just resting on its laurels, you know. They're looking ahead.
And then there's that last category, financing activities. What's that all about?
So financing activities, this is how they get the money to actually do all that operating and invest in. It includes things like issuing stock, taking on debt, or paying dividends to shareholders.
So it's like they're choosing how to fuel their engine.
Yeah, that's a good way to put it. They can share ownership, borrow money, or give back some of their profits to investors.
And the mix of those choices, that can tell you a lot about their overall strategy.
Absolutely. And about their financial health, too.
Okay, so I'm starting to feel like a real financial detective here. But are there any, like, red flags, things that would make you suspicious when you're looking at a cash flow statement? Like, what are the warning signs?
Oh, for sure. There are definitely some things to watch out for. One big one is if they consistently have negative cash flow from their operations.
So even if their income statement looks good, their cash flow could be telling a different story.
Exactly. If their core business isn't actually generating enough cash, that could mean they're relying too much on debt or even selling off assets just to stay afloat.
Ooh, that's not a good sign.
Not at all. Another red flag would be consistently negative investing cash flow.
So they're not putting enough money back into growing the business.
Right. It might mean they're cutting back on research and development, not upgrading their equipment, or just not taking advantage of new opportunities. And that can really hurt them in the long run.
It's like they're eating their seed corn instead planting it.
That's a perfect analogy. They're sacrificing the future for short-term gains.
And that never ends well.
Nope. Remember, the cash flow statement, it's all about sustainability. Can this company keep doing what they're doing? Are they built to last, or are they living on borrowed time?
This has been so eye-opening. I never realized how much the cash flow statement could reveal. It's like a whole other dimension of the company's story. So we've covered the three major financial statements now, but Harvard Business School also mentioned the annual report and the 10K. What are those all about? How do they fit into our investigation?
All right, so think of the annual report kind of like the company's highlight reel, you know?
Yeah.
It showcases all their successes, their mission, their vision for the future.
So it's kind of like a polished marketing brochure.
Yeah, it definitely has that element. But for a deeper dive, we got to go to the 10K. This is a more detailed document. It's actually required by the SEC, the Securities and Exchange Commission.
So it's the official, no-nonsense version.
Right, and it gives a much more in-depth and sometimes, let's say, unvarnished look at the company's operations, their financial performance, and even the risks they're facing.
So if the annual report is like the movie trailer, the 10K is the full movie with all the plot twists and character development.
I like that. That's a great way to put it. The 10K is where you'll find all the nitty-gritty details, the footnotes, the legal disclaimers, all that stuff that might not make it into the glossy annual report.
Okay, so the 10K is where the real detective work happens.
For sure. It lets you really see behind the scenes and uncover the things that might not be obvious at first glance. You know, with all this talk about investing, it makes me wonder, does any of this financial statement analysis stuff actually apply to day trading?
Oh, that's a great question. I mean, day traders, they're focused on such short-term price movements.
Right, like minutes and hours, not months and years.
Would they even care about a company's long-term debt or like how much their equipment's depreciating?
That's the million-dollar question, isn't it? They seem like totally separate worlds.
Right. It's like speed demons versus, I don't know, meticulous archaeologists or something.
I love that. But, you know, maybe there's more overlap than we think. Maybe there's a way to connect those dots.
Okay, now you've really got me curious. How could you even begin to bring those two worlds together? So we've got these two worlds, right? The like super fast-paced day trading and then the more, I don't know, in-depth analysis of financial statements.
It's the hare and the tortoise of the financial world.
Yeah, exactly. But could they actually work together? Could you use those financial statements, which are all about the long game, to actually make better decisions in day trading, where it's
Yep.
all about those tiny, short-term price moves?
A lot of people would probably say, no way, right? Like, day traders are just chasing momentum. They don't care about the fundamentals.
Yeah, they're just looking for those quick wins.
But I actually think there could be a way to blend these approaches, like a kind of synergy between them.
Okay, I'm listening.
Yeah.
How would that even work?
Okay, imagine this. You've been doing your homework, right? You've analyzed a company's financial statements. You really understand their business.
We've got our detective hats on.
Right. And you found a company that's like fundamentally strong. They've got great growth potential. Maybe they're about to release a really positive earnings report or announce some big partnership.
But the market hasn't caught on yet.
Exactly. The stock price hasn't fully reflected that good news yet. So as a day trader, you could use that knowledge, that deeper understanding of the company's value to kind of anticipate how the market's going to react.
So you're not just riding the wave, you're actually like predicting the wave.
Yeah, you're combining the technical skills of a day trader with the analytical mindset of a long-term investor.
That's like you're playing 4D chess or something.
Haha, kinda. You're thinking several moves ahead, not just reacting to what's happening right now.
And on the flip side, maybe understanding how day trading works, like the psychology of those quick market moves, could that actually help long-term investors too?
I think so, yeah. It can give you a better feel for, like, market sentiment, how people are reacting to news in real time. Because even if you're a long-term investor, you still got to navigate those short-term fluctuations.
It's not just one way, it's like a two-way street.
Right. Each approach can actually inform and improve the other. It's like this constant feedback loop.
This whole idea of a hybrid approach, using both technical and fundamental analysis, I love that. It's like you're getting a more complete picture.
Exactly. It's not about saying one way is better than the other. It's about recognizing they both have strengths, and if you can combine them, you can make smarter, more strategic decisions.
Whether you're a day trader or a long-term investor.
Exactly. And that's what it's all about, right? Making informed decisions, not just gambling.
This deep dive has really opened my eyes to like a whole new world of possibilities.
Yeah.
It's not just about learning some rules. It's about developing this deeper understanding of how the market actually works.
And remember, this is just the start of the journey. The more you learn, the more connections you'll make, and the more confident you'll become in navigating the whole world of finance, you know?
So to our listener, I hope this is giving you a taste of what's possible when you combine the energy and excitement of day trading with that kind of more careful, methodical approach of financial statement analysis. It's a journey. Keep learning, keep asking questions, and you'll be amazed at what you discover.
The world of finance, it's always changing, so stay curious, stay informed, and never stop learning.
And that's a wrap for this episode of The Deep Dive. We'll catch you next time for another deep dive into the world of knowledge and exploration.